Hello and welcome. I'm continuing my series on introductory financial modeling techniques using the questions from the old ModelOff World Financial Modeling Championships. So this week we're looking at round two, round two from 2014. And we've got three, as usual. I'm going to skip the MCQs because I don't think they make for a very good video. So today we're going to look at time is money. That's all about an international acquisition, real and nominal exchange rates, and real and nominal exchange rate forecasts. Then Wednesday, I'm going to be looking at this one, which is about auditing a model, trying to find errors in somebody else's model. And Friday, I'm going to be looking at this one, Purple City, which is one of my all-time favorite ModelOff questions, which is basically trying to work out the transportation costs of a fictional soccer tournament. But let's dive on into today. So today's case, time is money. 35-minute question. So as usual, I'm going to try and keep this to a 35-minute video. Not going to lie, I worked on this one in advance, made a couple of mistakes, so now I'm coming at it with with the advantage of having had a recent look at it. So I'll probably be quite a bit faster than 35 minutes, but that is what it is. So you work at a company called eTech. eTech is based in Europe and does financial statements in euro. You have a corporate model for analyzing the impact of acquisitions, and that is prepared in euros on a nominal basis. I'll talk a little bit about real versus nominal in a minute if that's new to you. So we want everything converted into nominal euro. We're looking at acquiring a tech division from a company called GEE, and we have an information memorandum with lots of information about, over here on the data tab. So this is our information memorandum. So US-based Co. LLC. Excellent imaginative name there. So we've got the forecast revenue, OPEX, CAPEX in two different asset classes, opening balances in two different asset classes, depreciation methods, and taxation rate. And this is all in real US dollars. And we're told, yeah, that's already in there. All cash flows happen on the last day of the year. Taxes calculated on the last day of the year, paid immediately. So in other words, there's no kind of deferred anything, and all timings are year end is relevant when we come to the discounting. Depreciation. So for Class A assets, double declining balance method over 5 years, and that'll apply both to the opening balance and to new CapEx. For Class B assets, straight line method over 4 years. Now, the thing you need with straight line method, which it gives us here, that you don't need with double declining is how old is the stuff that you're starting with, because so it says here as a kind of simplifying assumption, assume the opening balance has not yet been depreciated. So we depreciate that over 4 years starting in 2015. That's, like I said, a simplifying assumption would be more realistic to say, well, some of it is this old and some of it is this old and some of it is this old, but that's not what we're focusing on for this question, so we're not going to worry about that. So just assume none of it has been depreciated. Then these are your assumptions after talking to accountants, tax advisors, whatever. I remember this sentence from when I first read this question. I'm sure it was meant in a kind of very narrow technical sense, but there are no cross-border implications from the acquisition. I loved, just very tickled by how sweeping the statement was. Anyway, we'll discount pre-financing post-tax nominal US dollar cash flows using a 10% rate in order to value the assets as of the 31st of December 2014. Spot exchange rate at the valuation date is $1.31 per euro, and you have a real USD to euro forecast. I'll talk about that a little more in a second because, like I said, I'll talk about real, nominal, all that fun. And you have a view on inflation for both the dollar and euro in the attached workbook, and then we get into questions. So let's see the assumptions we have here. So we have a real exchange rate forecast, and we have an inflation assumption for dollars and euros. So quick explanation, if the topic is new to you, real versus nominal dollars. Basically, real means preserving the purchasing power as at a certain time adjusted for inflation. So specifically, real here, whenever we talk about real in this question, we're talking about real 2014, December 31st, 2014 dollars. So in other words, if you had a dollar at the end of the 31st of December 2014, you could buy whatever, a dollar candy bar, to use a very American example, because I never said candy bar when I was growing up, but whatever. Then if there's 1.5% inflation the next year, you would expect that same candy bar to cost you $1 and 1.5 cents the next year, and then another year of 1.5% inflation, you'd expect it to cost you about $1 and 3 cents the next year. So a real 2014 dollar is the purchasing power equivalent of $1 in 2014. So in other words, the 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 alternative to real being nominal, i.e., what do you actually have to spend? So the one real dollar by the time you get to 2016 would be worth about $1 and 3 cents nominal. And similar idea for euro, except that there's a slightly different exchange rate forecast. So by the time you get out all the way to 2037, which is where this forecast goes to, your one real dollar is probably going to be worth like $1.50 or something like that. By the way, I was very tickled when I looked at this to see what they had forecast for inflation for 2022. That proved a little optimistic, but then that's the nature of long-term forecasts. They're always wrong. So let's dive in and start building a model. First thing I'm going to do, quick aside, by the way, I noticed how often I was saying in my recent videos, you can't see my status bar, but down here it says the sum is this, or the max is this, or the min is that, or whatever. I think that's because the aspect ratio of my screen is a little taller than a YouTube video. So got cut off. So now I've shrunk my window a little bit so you can see my tab names here, and you can see my handy dandy status bar, which you haven't been able to see for a while. So just thought I'd mention that before I grab this tab, because that's another thing that you haven't been able to see me doing for the last while. So I'm going to make a copy of this tab, call it model, and just to be consistent with the way that this is done, we'll do that, and then clear out all the assumptions. Luckily we've got all the periods nicely laid out here. I'm just going to hide all the extra columns because that makes it easier for me to Control-Shift-Right and copy across and all that good stuff. I don't know what that 0 is doing there. I'm going to get rid of it. Anyway, so first thing I'm going to do is the FX rate forecast. So let's start with, I'm going to turn these into inflation indices. So in other words, the index is basically that kind of purchasing power equivalent. Sorry, I'm going to make these red because the first row I want to be different. Sorry, first column because it's a different formula. So here I'm just entering a value, and then for the rest I'm going to be putting a formula. Multiply by 1 plus this. Copy across, copy down, 2 decimal places is good. So yes, so here you can see your one real US dollar to have the same purchasing power, the number of nominal dollars you need is 1.56, whereas euro, much lower inflation forecast, you only need €1 and 26 cents to match 2014 purchasing power of €1. So, sorry, this, for some reason, a bunch of cells here are formatted as like weird gray text. I don't know why. So I'm just gonna take this and just put it all over here, and I will take this, put it all down here. Okay, so then I want my nominal, what do we have here? Nominal USD per euro forecast, rate forecast. And I guess just for simplicity, let me put in the real one here. So these values are the real forecast. And just, I guess, a quick aside, again, I'm not an economist, but why are you forecasting? Why are you forecasting a real exchange rate and inflation rates and all this complexity instead of just forecasting, what's the actual US to euro exchange rate going to be? Well, if you look at the assumptions here, you can see the prediction is to have a steady real exchange rate for most of the period. So we have a few years of kind of gradually coming down to this, and then it hits 1.25 in year 4, and it just stays there. And that is somewhat based on economic theory, which is kind of saying the long-term driver of the exchange rate between euro and dollar should be sort of purchasing power equivalence. So in other words, if the USD inflation is persistently higher, euro inflation is persistently lower, then you would expect a euro over time to buy more, €1 to equate to more and more US dollars to have the same purchasing power, because the purchasing power of the dollar is declining by more. And so there is some economic theory about purchasing power parity or something that basically says, in theory, with certain simplifications, I don't know it exactly, you would expect the real exchange rate, adjusting for inflation reducing purchasing power differently in two different countries, to stay about the same over the long term. So this is just, if you feel like you have a better handle on inflation in two particular currencies than you have on long-term FX forecasting, then you can just get a medium-term forecast and assume that this year stays the same for the rest, and that's not a crazy way to make a long-term FX rate forecast. So, how do you turn the real forecast into a nominal one? Well, the short answer is you take this, you divide it by this, and you multiply it by this, and you carry that across. Now, what the heck just happened? Or why are we doing that? Well, let's try it longhand, right? So think about it. This is telling you €1 buys you this many dollars, right? So let's start with €1 real. Then if you convert that to nominal euro equivalent, you just multiply by this inflation index here. So your €1 real is worth €1.26 nominal. But then we can also use this real FX rate to convert it into real USD equivalent. And that is 1 multiplied by that. And then you can use your USD inflation to convert that into a nominal USD equivalent. And that's the real multiplied by the inflation index. And then you can say nominal USD per nominal euro. And that is, you divide the nominal USD amount by the nominal euro amount, and that gives you the same number as here. So, or another kind of more intuitive way of thinking about it is, if you kind of get, in theory, you're going to multiply by one of these, divide by the other one. The way to think about it is, I'm using euro to buy dollars, and we're saying the purchasing power of dollars is going down more over time. The purchasing power of euro is going down less over time. So in other words, my euro should be buying me more dollars over time. So you're going to basically want to divide by the smaller one and multiply by the bigger one here to get that. So I'm going to kind of leave this here just in case you find that helpful. That's just a kind of way of thinking about things. And I guess I should fill in. I'll leave the units alone for now. Okay, so that's the FX rate forecast. And now that we have that, we can do the company forecast in nominal USD. So first thing we can do is just take the pieces we have here, and instead of real dollars, we want to have this in nominal dollars. Slightly bugging me seeing US dollar everywhere. I'm just going to replace that with USD. And do it here as well, because that's how I'm used to looking at it. Okay, so this is just, sorry, nothing in 2014, so leave that black, start in 2015. So it's going to be that. So this is real, so we want to multiply by the inflation index to get the nominal equivalent. So just multiply by that, and it fills all in. And actually, you know what? I'm actually not going to make it an array formula. I'll just do it old-fashioned way. Okay, so that's the revenue and capex. So now what we need is asset schedules to figure out our depreciation. So asset schedule class A. So we're going to have opening, depreciation, capex, and closing. Now, I'm putting depreciation before capex just as a kind of simple way of reminding myself that capex is happening at the end of the year. So any capex isn't going to be depreciated in year. It's only going to be depreciated the next year. So my depreciation is only going to refer to my opening balance, basically. I don't know why it keeps doing that. Anyway, okay, so my closing balance for Class A is over here, and this is in real dollars, but again, real 2014 dollars. So that's because I'm looking at December 31st, 2014. Real and nominal are the same, so that's not a problem. G18, and I'm just going to make that red because I always like to make things red when they're a different formula from the rest of the row. Okay, so then my opening balance, previous period's closing, and my depreciation for this one, Class A, is double declining, 5-year term. So I'm going to link the 5 years over here, and just have a little gray thing there. So we're going to say minus the opening balance times, divided by the useful life times 2. Carry that across. Then the capex, we just got it up here. And sum all those up, carry that across, and we're all set. So let's do Class B. I don't know why. If anybody knows why, I can't even reproduce it now. Half the time that I press copy, I get this annoying pop-up that I can't put it on the clipboard, but it does end up getting copied. I don't know why. Anyway, so here, G21s, this one goes to G22. This one is G18s, this one will be G19. And here I'm going to split the depreciation between opening and new. You could kind of fudge this by just sticking the opening balance here and pretending it was 2014 capex, because that lines up with the fact that you're told it hasn't been depreciated at all. But just for clarity, I'm not going to do that. So, boom. So I'm going to say minus this divided by this. That's the depreciation for each year of the useful life. And then how do I figure out if I'm in the useful life? I can say if, got a handy counter up here, this counter is less than or equal to useful life. Then give me that depreciation, otherwise 0. Copy that across, all good. That stays the same. This needs to be redirected to the right line there. And then it's just this piece that I need to work out. Now, this is a nice one to talk about, how far we've come in the last, I guess, 8 years since this question was set. Because, well, so let's talk about a few options. So we're interested in straight line depreciation, meaning, this asset is going to depreciate over these next 4 years. This asset is going to depreciate over these next 4 years, and so on. So in other words, in any given year, I'm interested in depreciating assets acquired in the previous 4 years. So a few ways that you might think about doing that. I guess let me just lay out a separate section, depreciation, SL depreciation formulas. So let's just do last 4 years capex. So simplest option, and obviously as soon as I say the simplest option, you know it's going to be fraught with peril, is just to sum up the previous 4 years. And you can see from the fact that I'm doing it here that I'm going way outside the range of these actual things because I need to do that. Now, the first problem with this is that, if instead of 4 years I have something with a 20-year useful life, then this is going to go off the end of the sheet. But spare that problem. Second problem is you're not referencing the number 4 as an assumption. So if at some later point I said, oh wait, no, it's not 4 year, it's 5 year, I go in here and change it. Well, you generally expect if you change an assumption, it flows through everywhere, but in this case, it won't. You have an assumption here, but it's not actually driving anything. And here you've hard-coded the assumption that you're interested in the number 4. So that's one way to do it, but it's not a great way. So there's option 1, straight sum. We'll just call it sum. So option 2 would be offset, for example. And that would be sum offset from here how many columns? We go back 5, and the width is 4. I copy that across. No, sorry. Yeah, sorry, go back 4, not 5. And now it matches up. So now at least the good news is that the 4 is factored in. That also means if I come along later and insert a column here, this is now pointing to 5 columns, and if I copy it across, that's going to start to change the answers. So this option is sort of fragile to inserting columns. So I guess let me just put a note. I'm going to get rid of this just so I have more room to put notes. Some hard codes assumption, fragile to inserting columns. So this is flexible assumption, fragile to changes outside range. What do I mean by that? Well, let's say we're being good modelers. Maybe we come along and insert here a nice little check column, widen this one out and say, all right, I'm going to have a check column here that says the sum of everything along the column, just so I can see, what's my total revenue over the forecast period, blah, blah, blah. Well, now suddenly this has gone completely nuts because it's including your 20-year CapEx forecast. Okay, so that's also not good. So that's flexible assumption, but fragile to changes outside the range. Option 3, offset with a limit. And that is flexible, stays in range, but volatile. So what does that look like? You could do something like, whoops, put it back up there. You could do something like minus the min of 4 and this. And then the min of 4 and this again. Now that will continue to refer to one empty cell, so it'll sum this cell, and then these 2, and then these 3, and then these 4, and then so on. But that's a lot easier to deal with because you can just say, okay, I'm going to format that as, this is a format I tend to use for an empty cell, but it is referenced. So don't put something in here because that'll mess things up. So that's better. And you can just, you should see with all of these, they continue to give the same answer. That's better, but offset is a volatile function. So if you have a big model, think about if I have rand in here, if I make some change, nothing is recalculating this model except rand, because rand is volatile, which means it needs to recalculate all the time. But you don't see it with this one because the value isn't changing, but offset is also volatile like that. So Excel is generally very smart about not recalculating things it doesn't need to, but offset is an exception to that. So both of these, if you have a big model and if you have a lot of things that depend on these, every time one of these cells, every time anything changes, each of these cells will recalculate, and everything depending on those cells will recalculate. So if you have a big model, volatility is a problem. It's not as big a problem as, frankly, some people make it out to be. But anyway, so option 4, this was my preferred method in the old days, sum ifs, and that is flexible and stays in range. And that is just going to be sum ifs, take the whole CapEx range where the period number is what you're interested in. So what period numbers are we interested in? Well, we're interested in ones that are less than the current period. So less than this, and that are no more than 4 periods old. So greater than or equal to current period minus the useful life, which is down here somewhere. Sorry, I realized after I said that I'd made the assumption flexible, but actually I still just had the number 4 in there, so that is completely hard-coded. Pardon me on that one. It is capable of being non-hard-coded, even if I had hard-coded it. So let's fix that, copy it across, and then let's see if I've done the sum ifs right. I have not done the sum ifs right. Have I? What? It's changing here. Oh, sorry, because I said great. sure I said greater than or equal to, but apparently I didn't type the equal sign. All right, now it's checking out. So SUMIFS is giving the same thing. The last option, the kind of modern Excel option, and then I'll stop talking about 1,000 different ways to do depreciation, is to use take. And that, the one slight disadvantage is it does still refer to one empty cell, but it does have the flexibility advantage. So basically the idea is I'm going to, from the array of all the past capex, so starting from column G, just because I have to refer to one period before, from the array of past capexes, I want to take the most recent 4. The nice thing about take is that it'll automatically size itself if, what am I saying? If you try to take the last 4 columns of something that only has 2 columns, it just gives you the 2 columns. It doesn't kind of freak out or anything like that. So let's see, this one successfully replicates the same thing. Or option, we'll call it 5A, take drop if error. This is basically just a way to adapt this one to stay entirely within the range. So the challenge with this one is that it can't include the current period, but what you could do is you could drop from here 1 column and then take from that -4. The only issue is that it'll error out on the very first one. Sorry, drop from this -1 to take out the last column. That's better. And then you just need an if error. So in the one starting period, that will throw an error because there's nothing there. And the kind of business interpretation of that is fine, no capex, then there's no depreciation. Anyway, so that is 6 different ways to work out your previous 4 periods capex. I'm going to take one of these at random. Let's use take because I like it. I'll use the one that doesn't refer outside. Kind of torn on which of these I prefer. This one refers outside the range, but only to one cell, and it's a much simpler formula than this one. So I'll use this one. Whew. That was a long detour. Oh, and look, I've done it again. God, what's wrong with me today? I've typed in a number again. So let's fix that and that. Copy those across. Then take this formula. And now eventually, we make our way back from the extremely long detour and divide this by this number here. And that gives me my depreciation. Okay. Whew. Way around the houses there. All right. So now we need to figure out taxable income, and that is our revenue. Where is it? Our revenue. Sorry, actually we should depreciation total would be a useful number to have in one place, and that is going to be this plus this plus this. Oops, no, I need to move that. I meant to add another one. There we go. Now my taxable income. I'm going to have to speed up now because that very, very long detour is going to push me up against the limits of my commitment to try to keep the video no longer than the question time. So that's taxable income. Tax, which is 40% of that, minus this times this. And then our post-tax pre-financing cash flow. It's what we were interested in discounting. So the cash flows here are, again, absent any working capital assumptions. Revenue minus OPEX is your cash flow minus both flavors of CAPEX and minus tax, but with a plus sign because I've calculated tax with a minus sign on it. So that's my post-tax pre-financing cash flow. Now I'm going to take all of this and very quickly produce the nominal euro forecast. Company forecast in nominal euro. Realized I need to make this reference lock if I'm going to copy it down. And then get rid of all of this and this. And that doesn't need to be a different format anymore because they're all going to be the same formula, which I will get to in just a second. And all of these. USD can become euro. And I didn't extend my labels, so let's finish labeling. Depreciation, taxable income, tax. Bring these down, do the same thing. All right, and then here's where the magic happens. We're going to select this whole range, Control G, go to special, all the formulas in that range, and wherever there's a calculation in here, the number for the euro forecast I want is just the equivalent USD number divided by the nominal forecast. Whoops. Lock that, lock the row but not the column, Control Enter, we'll fill that in everywhere, and now I've got my nominal euro forecast. Nice and simple. Okay, so, oh yeah, I remember I deliberately got rid of those so that we could read the notes, but whatever, doesn't matter. Let's quickly do a Q&A. So that's 7 questions, I think. Start. Okay, question 1. What is the nominal exchange rate in year 7? Up the top here, somewhere here, nominal year 7. Oh, more decimal places, 1.324, which is D. What is revenue in year 2 in nominal euro? Come down here. Revenue in year 2. That's 740, which is A. Depreciation for both asset classes in year 6 in nominal euro again. Total depreciation, nominal euro, year, did I say 6? I think I said 6. And again, sorry, no, this one was 1 decimal place, yes, so that's B, 269. Question 4, net profit before tax in year 4 in nominal euro. So net profit before, sorry, where are we? I called it taxable income. In, what year did I say? Year 4, good, yes. 44.4, that's A. Okay, what is the tax expense in year 8 in nominal euro? Tax, year 8. Boom. And we're back to no decimal places now. This one's a little up and down. But 80 is option C. Question 6. Okay, so here's where we do the NPV. So we're interested in the NPV of the first 10 years of cash flow, and we're interested in the XNPV of the same thing and how it changes. Now, this is where you need to be very careful. It's one of the technical things in this question, which is we value the asset by discounting USD cash flows, even though it's asking for the answer in euro. So the key thing here is do your workings in dollars and then convert. Don't do the workings in euro. So NPV of first 10 years using NPV, and then the same thing using XNPV. So it's going to be NPV. Sorry, where's my... Just going to give this a name because I'm going to need to refer to it a bunch. Disk rate. So NPV, disk rate, first 10 years is there. And then XNPV, disk rate. Sorry, disk rate. My values. Now, importantly, I need to include 31st of December 2014 in my date range, so I need to include it in my value range as well. So I'm going to have 11 columns. My dates are going to be up here. And now throw the value error because it wants there to be a number in here. So I'm just going to put hard-coded 0 in there, and then it's happy. You can see the numbers are slightly different, but not very different, which is kind of exactly what you'd expect. Sorry, then I need to grab this. And then it's going to be the exact same formula. So first question is this. To the nearest euro, so that's 519, which is B. And second question is, how much does it change? So that's going to be this one minus this one times 10 to the 6, which is closest to 181,000, which is C. All right, so let's see if we got it right. DABA-CBC, DABA-CBC. Cool. Now, I am going to end up going over the 35-minute time, but for vaguely educational reasons, the model has done. But let's just explain a couple of things. there are a couple of things you need to be quite careful with if you're doing a model like this. The first one is, so I remember when I did this in 2014, I got this question totally wrong because I saw that we were interested in answers in euro, nominal euro. So I did the FX workings and then I promptly converted all numbers into nominal euro and then built my model from there. That gets you wrong in two ways. The first thing is you think about your depreciation. So a good example is just look at the depreciation on the opening balance of asset class B. It's straight line depreciation, so it's equal in every year. But that's not true when you FX convert it. So here's the same thing in euro, and it's slightly different numbers every year. So if I convert to euro first and then calculate straight line depreciation, I'll get a quarter of this number every year, and it'll be straight line. But that's not the right way to do it. You have to work out depreciation based on the nominal expense in local currency and then convert. And that leads to all kinds of consolidation complications that are out of scope for this question, and are a good reason to hire accountants if you want to make international acquisitions. But the important thing to understand is you won't get the same answer if you build your model if you convert everything to euro and then build the model. If I just converted all these assumptions to euro and built the model, it would be a different answer than building the model and then converting everything to euro. That's the first place it happens, and the second place it happens is in this discounting. So let me just put it here for comparison. Discount in euro, just so we can see that it does actually come up with a different number. So here it will say, same formula, it will say NPV of disc rate and the first 10 years. So you can see that's the USD discount converted to euro, and this is directly discounting the euro numbers, and I don't need to do that. Well, now that I've labeled the second section, I guess I better do the same thing here. So disc rate values, again, we've got to include that one extra column because we're discounting back to the 30 XMPV discounts back to the first date that you give it. And we'll block those. And again, it freaks out. And we'll just put in that, or actually, you know what, you can even just use the same formula because I put in that 0 up there. So you can see that these are different numbers as well. And why is that? Well, it's because when you discount everything back to 2014, then you're doing the conversion at 2014 FX. But when you convert each period separately, you're converting each one at a different FX rate. They only come out slightly different because the rate isn't forecast to change all that much. It hovers around the kind of 1.3 area. But if you were working with a currency that was more like if you were working in a developing market where the inflation rate was routinely kind of more like 10% than like 2%, then these differences could become quite pronounced. So that's just, to me, this kind of thing is like, oof, slightly scary. Better be careful. But thing to be aware of is you got to do your depreciation nominal local currency, and you've got to do your discounting, well, on whatever basis makes sense for you. There might be a business case for either one of these, and like I said, in this case, they're not that different from each other. But just be aware that you will get different answers if you build your accounts in one currency and then convert than if you convert everything and then convert all the assumptions and then build. All right, that's my few extra minutes of grumpy old man shakes his fist at you. Got to be careful. That's all I got for today. I'll be back on Wednesday with model auditing. Thanks for watching.